Welcome to Finance Frontier, where we guide you through the complexities of today's most pressing financial trends. Today, we're broadcasting from the heart of Wall Street, right outside the iconic New York Stock Exchange. This location has seen it all, everything from the Great Depression to the 2008 financial crisis. It's fitting, really, because we're here to talk about a financial challenge that's looming large in 2025, record-breaking global debt levels and persistent inflation.
Just think about the scale. U.S. debt alone is approaching $35.8 trillion, and we're seeing similar trends across Europe, Asia, and emerging markets. This debt isn't just a national issue. It's global, and it's affecting everyone. From major financial institutions to individual households, debt and inflation are driving up costs across the board: groceries, rent, fuel, and squeezing the budgets of families worldwide.
Today's episode, The Debt Dilemma, Inflation Risks of Global Debt in 2025, will help you make sense of it all. We'll explore the strategies that investors, economists, and even governments are considering as they look to shield themselves from rising costs. The big questions are, can we protect our wealth as debt continues to surge? Should we focus on inflation-resistant assets like gold, or are there other ways to safeguard our investments in this heightened landscape?
And we're not just here to talk numbers. We're here to provide actionable insights. We'll break down expert-recommended strategies designed for this very scenario, giving you the tools to make resilient financial decisions. From bonds and commodities to inflation-protected securities like TIPS, we'll discuss the assets that could shield your portfolio as inflation puts pressure on the value of cash.
There's also the very real, human side of this crisis. On social media, people are voicing their concerns, worrying about retirement savings, struggling with higher food and gas prices, and trying to make sense of rising mortgage rates. Tweets like, "Gold is the only thing standing between my savings and inflation," or "How much debt can this economy handle before we see major consequences?" capture the urgency and uncertainty that so many are feeling right now.
That's why today's episode is so crucial. By the end, you'll have a toolkit of strategies to not only protect your wealth, but also position yourself for resilience in this unpredictable environment. We'll cover everything from inflation-protected assets to portfolio diversification, equipping you to navigate what could be one of the most challenging financial periods of the decade.
So, if you're concerned about what the future holds and want to take proactive steps to secure your financial well-being, stay with us. This isn't about reacting to headlines, it's about understanding the bigger picture and making choices that safeguard your future. Consider this your guide to navigating the global debt dilemma.
As we dive in, don't forget to subscribe to Finance Frontier, share this episode with others facing similar financial concerns, and stay connected for more strategies to navigate these volatile times. Now let's jump into today's debt dilemma and explore the inflation risks that lie ahead.
Welcome back. Today's top story focuses on a financial storm that's affecting nearly every economy on the planet: rising global debt coupled with stubborn inflation. These aren't just abstract numbers, they're forces shaping markets, policies, and personal finances around the world. As debt levels climb, so does the pressure on our wallets, from mortgage rates to everyday essentials.
To put things into perspective, U.S. debt alone is now at approximately $35.8 trillion, with debt levels rising across Europe, Asia, and emerging markets. Managing this kind of debt puts intense pressure on governments and central banks to keep economies stable. But with inflation also in the mix, every policy decision they make is a double-edged sword, impacting borrowing costs, currency values, and ultimately, the cost of living for everyone.
One of the biggest challenges is the relationship between debt and inflation. When debt levels rise sharply, governments often rely on monetary policies like quantitative easing or issuing more bonds to manage it. However, injecting this much liquidity into the economy can devalue the currency, leading to inflation, where the cost of goods and services climbs. This creates a vicious cycle. High debt fuels inflation, which makes borrowing more expensive, leading to even more debt.
For investors, this environment is a game changer. Bonds, traditionally seen as safe investments, are facing pressure like never before. As central banks hike interest rates to control inflation, bond prices drop, especially for long-term bonds. This situation is challenging for those relying on bond income, like retirees who count on stable returns. It's no surprise, then, that many investors are reconsidering their bond allocations.
To combat this, some investors are turning to Treasury Inflation-Protected Securities, or TIPS. TIPS are bonds that adjust with inflation, helping to maintain purchasing power even as prices rise. They've become a go-to for those wanting a safety net against inflation without the extreme volatility of equities. Currently, TIPS yields are around 2 to 2.5%, providing a straightforward hedge against inflation.
Commodities, particularly gold, are also seeing renewed interest. Historically, gold has held its value during inflationary times, making it a solid choice when currency values fall. Recently, gold prices have climbed to around $2,760 per ounce, signaling that investors are positioning defensively. Alongside gold, other commodities like agricultural products and energy resources are gaining traction as tangible assets that can protect against currency devaluation.
Real estate is another potential inflation hedge, especially for those already holding property. Property values tend to rise along with inflation, offering both appreciation and rental income. However, with interest rates climbing, new real estate purchases can be more costly. Experts recommend focusing on properties in high-demand areas, as these locations typically appreciate faster, offering a buffer even in turbulent economic times.
Central banks play a crucial role in managing these challenges. The Federal Reserve's recent rate hikes, currently holding steady in the range of 5.25% to 5.50%, are designed to stabilize inflation, but they come at a cost. Higher interest rates can slow economic growth and increase the cost of debt for both consumers and governments. The Fed's actions set the tone globally, influencing other central banks. When the Fed acts, markets around the world react, making it essential for investors to stay informed on these policy shifts.
And this isn't just a U.S. issue. Central banks in Europe and Asia are taking similar steps as inflation becomes a global problem. Rising rates in one country can affect currencies in others, making international investments both riskier and potentially more rewarding. For example, as the dollar strengthens with rate hikes, emerging markets that borrow in dollars face tougher conditions, with debt servicing costs on the rise.
Experts are advising investors to diversify portfolios with a mix of defensive assets and shorter duration bonds. High-yield corporate bonds, especially those from financially stable companies, offer higher returns that can counter inflation but come with added credit risk. Shorter duration bonds are more resilient in a rising rate environment, as they're less sensitive to interest rate changes than long-term bonds.
In summary, today's top news highlights a challenging environment for governments and investors alike. With inflation eroding purchasing power and debt levels reaching historic highs, adapting to these trends is crucial. In our next segment, we'll turn to social media to see how investors are reacting in real time to these economic shifts. Stay tuned as we dive into the conversation happening online and explore sentiment surrounding today's debt and inflation dilemma. Now that we've covered the top news, let's check in on the real-time conversation happening across social media. Platforms like Twitter and LinkedIn are buzzing with opinions, concerns, and strategies as investors and everyday people react to the ongoing debt and inflation dilemma. This digital pulse offers a unique look at how different perspectives are shaping up in response to rising costs and economic uncertainty.
One tweet that stands out says, "Debt levels like this can't end well. Inflation will eat our savings if we don't act now." This sentiment reflects a growing worry among both investors and the public. People are watching their purchasing power diminish as inflation persists, and for many it's impacting everyday costs, food, fuel, housing, on a very real level.
Another tweet brings a more strategic viewpoint. With inflation climbing, safe havens like gold and tips are the only thing standing between my portfolio and devaluation. It's a defensive approach that's becoming common on social media, with many shifting focus toward inflation-protected assets. This flight to safety mentality reflects a rising interest in tangible investments that hold value even as currency strength fluctuates.
It's not just individual investors who are joining the conversation. A financial influencer recently tweeted, "In times of high debt and inflation, Sectors like healthcare and utilities remain stable. Time to shift from tech to defensive stocks. This proactive mindset highlights a key theme. Some investors see current conditions not just as risks, but as an opportunity to adjust their portfolios strategically, focusing on essential sectors less susceptible to economic turbulence.
And the conversation is global. International investors are weighing in with concerns about currency devaluation and rising borrowing costs. One economist in Europe tweeted, "As the Fed raises rates, currencies worldwide are feeling the heat. The dollar's strength is squeezing emerging markets, making debt harder to service." This reaction underscores how interconnected economies are today, with U.S. policy changes affecting global markets and foreign debt dynamics.
Social media is also generating collaborative conversations about strategies. The hashtag inflation protection is trending, with investors sharing insights on preserving wealth. Some posts emphasize the importance of maintaining liquidity, as cash reserves provide flexibility in volatile times. Others advocate for high-yield corporate bonds as a way to earn returns that keep up with inflation, although, as we know, these come with added credit risk compared to government bonds.
The personal impact of inflation is another prominent theme. People are sharing how rising prices are affecting their daily lives. From gas prices to grocery bills, the effect of inflation is hitting home. Posts like "I'm paying double for groceries compared to last year" and "fuel prices are up 10% in my area this month alone" reveal the challenges many are facing and the urgency to protect their savings.
So, if you're listening and wondering how these social media insights might inform your own financial strategy, here are a few takeaways. First, the general sentiment is that inflation-protected assets and defensive stocks are top priorities. Additionally, maintaining liquidity and diversifying across stable sectors can offer resilience as markets continue to react to rising debt and inflationary pressures.
In our next segment, we'll turn to expert insights, building on these social media-driven strategies with professional advice from financial experts. We'll go beyond sentiment to provide actionable recommendations that can help you weather this period and potentially find opportunities in it. Stay with us for insights that can shape your financial approach in 2025. Now that we've explored the real-time sentiment on social media, let's turn to the experts. Financial analysts and economists have been closely studying the high debt, high inflation environment, and they've shared insights that could be key for protecting wealth and making strategic choices amid economic uncertainty. These aren't just theoretical recommendations, they're tried-and-true strategies based on past cycles of high inflation and market volatility.
One of the main recommendations from economists is to consider Treasury Inflation-Protected Securities, or TIPS. TIPS are designed to adjust for inflation, making them a popular choice for maintaining purchasing power. Unlike traditional bonds, TIPS are less impacted by rising inflation, as their principal and interest payments increase with the inflation rate. Currently yielding around 2 to 2.5%, experts often refer to them as a set-it-and-forget-it option because they automatically adjust to economic conditions, offering a straightforward hedge against inflation.
Another asset that experts frequently recommend is gold. Known as a safe haven, gold historically holds its value when inflation rises or the dollar weakens. Recently, gold prices have seen a steady increase, currently trading near $2,760 per ounce, signaling that investors are positioning defensively. Alongside gold, other commodities like silver, oil, and agricultural products are also popular, as they typically perform well in inflationary environments. Commodities offer tangible value and are less vulnerable to currency devaluation, making them solid options when cash loses value.
Real estate is also on the radar as an inflation hedge. Property values tend to rise alongside inflation, providing a dual benefit of appreciation and potential rental income. Experts note that real estate in high-demand areas, like major cities or growing suburbs, can provide stability even as inflation impacts other asset classes. However, with rising mortgage rates, financing real estate purchases can be more costly, which is why holding existing property may be a more practical option for many investors.
Another sector experts are advising investors to consider is defensive stocks. Companies in sectors like healthcare, utilities, and consumer staples are less sensitive to economic cycles and provide essential goods and services that people continue to need, regardless of market conditions. Stocks in these sectors have historically shown resilience during downturns, making them valuable additions to portfolios facing inflationary pressure. As tech stocks face headwinds from rising rates, shifting into these defensive areas could provide a more stable investment.
Experts are also recommending high-yield corporate bonds for investors looking to offset inflation with income. While traditional bonds have suffered in the face of rising rates, high-yield bonds offer a higher return, which can counter some inflationary effects. It's essential to remember that these bonds come with more credit risk, so focusing on bonds issued by financially stable corporations can be a safer way to achieve higher returns without excessive risk.
A crucial point experts are making is the importance of maintaining liquidity. In uncertain times, having cash or cash equivalent assets provides flexibility, allowing investors to seize opportunities as they arise. While cash may lose some value to inflation, the liquidity it offers can be strategically advantageous in volatile markets. Short-term Treasury bills, for example, provide liquidity and are relatively safe from inflation's effects since they mature quickly and adjust to rate changes.
Some financial strategists also highlight international diversification as a way to spread risk. By investing in foreign assets or markets less impacted by U.S. debt and inflation, investors can reduce their exposure to domestic economic challenges. For example, emerging markets with higher growth potential can offset the slower growth expected in debt-heavy economies. This approach isn't without risk, but it provides an avenue to balance a portfolio with assets that might perform better in different economic cycles.
The key takeaway here is that no single strategy will work for everyone. The experts we've heard from are emphasizing the need for a balanced, diversified approach that aligns with each individual's risk tolerance and financial goals. For some, this might mean holding tips and commodities. For others, it could involve sector rotation into defensive stocks or even exploring real estate and international markets.
And it all comes down to proactive planning. With high debt and inflation challenging traditional approaches, having a variety of tools in your financial toolkit is essential. By diversifying into inflation-protected assets, maintaining liquidity, and balancing risk with defensive stocks, investors can create a portfolio that offers both protection and growth potential.
In our next and final segment, we'll wrap up with a quick recap of today's insights and some final thoughts on positioning yourself for the future. Stay with us for the key takeaways and actionable steps to navigate this unique economic environment. As we wrap up today's episode, let's recap the key strategies we discussed to help you navigate this high debt, high inflation environment. First, we talked about inflation-protected assets like tips and commodities. By including assets that adjust with inflation, you're working to preserve purchasing power as prices continue to rise.
We also covered the value of defensive investments. Sectors like healthcare, utilities, and consumer staples are resilient because they provide essential goods and services, making them less vulnerable to economic swings. If stability is your goal, these assets could be solid additions to your portfolio.
And for those focused on flexibility, maintaining liquidity through cash or short-term investments is essential. While cash may lose some value due to inflation, having funds readily available lets you respond quickly to new opportunities in volatile markets.
Don't forget, real estate and international diversification can play a key role in rounding out a resilient portfolio. Real estate provides a potential hedge against inflation, while global assets help reduce exposure to domestic economic fluctuations, creating balance and adaptability in different economic conditions.
The takeaway here is clear: proactive planning and strategic diversification are more important than ever. Each of these tools, tips, commodities, defensive stocks, cash reserves, serves a unique purpose in a well-balanced portfolio. Understanding how to combine them can make all the difference as you navigate the challenges of debt and inflation in 2025.
If you found today's insights valuable, make sure to subscribe to Finance Frontier. Share this episode with others who might be facing similar concerns, and leave a review to help us reach more listeners. Together, we can build the knowledge needed to navigate these complex times.
Thanks for joining us today. Keep an eye out for our upcoming episodes, where we'll continue to cover the twists and turns of today's financial landscape, bringing you insights and strategies that matter. Until next time, take care and stay proactive in your financial planning. This episode of Finance Frontier is for informational purposes only and does not constitute financial advice. All opinions expressed are those of the hosts and may not reflect your individual financial situation. Always consult a qualified financial advisor before making investment decisions, as markets are volatile and investment risks include potential loss of principal. We've used trusted sources to ensure accuracy and relevance, but remember to consider how this information applies to your specific financial context. Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier Copyright 2024. Unauthorized reproduction or distribution is prohibited.